What if I told you the holy grail of quantitative finance, consistently beating the market, doesn't actually require a supercomputer running some impenetrable black box AI? Welcome to this explainer, where we're going to dive into a completely fascinating new approach called Observable Matrix Dynamics, or OMD for short. It's a system that suggests just three fixed-size matrices, built purely from plain old historical data, might literally be all it takes to build an incredibly robust, market-beating portfolio. So let's jump right in and see exactly how this works.
Right out of the gate, we're faced with a pretty profound question. Can three simple matrices actually beat the S&P 500? Now, classical finance theory, specifically the efficient market hypothesis, says absolutely not. The textbook argument is that current prices already have all available information perfectly baked into them. And yet, if you look closely, market anomalies like momentum just stubbornly persist. What's brilliant about this research is that it doesn't just ask the question in theory, it actually tests it empirically. The core idea here is that the secret to beating the market isn't about digging up some hidden proprietary information. It's simply about representing the data we already have, like daily prices and trading volumes, in a fundamentally better, smarter way.
To really appreciate this, we need to contrast it with the old guard. Think of traditional portfolio theory, like Markowitz mean variance optimization, as our Goliath. For decades, quants have relied on this method, which tries to predict exact expected returns and requires inverting these massive, unwieldy covariance matrices. The problem? It's incredibly fragile. It's kind of like trying to balance a pencil on its absolute tip. The slightest error in your inputs, and the whole portfolio just falls apart in the real world. So, enter our David, the new OMD framework. Instead of wrestling with raw percentage returns, it focuses on dynamic cross-sectional ranks. Because it looks at relative rankings, it completely bypasses that fragile matrix inversion, allowing the model to smoothly and continuously adapt as the market evolves.
So, let's meet our three heroes. Believe it or not, the entire complex state of the S&P 500 is distilled down into just these three matrices. First, we have a distance matrix, which basically maps out how stocks move together. Second, a return rank Markov chain, tracking relative performance. And third, a volatility rank Markov chain, tracking relative risk. That's the whole shebang. There are no forward-looking analyst estimates here. No complicated neural networks prone to hallucination. We are looking at pure observable market mechanics.
Let's break these down, starting with the distance matrix. Instead of just looking at standard correlation numbers on a spreadsheet, I want you to imagine the market as a physical globe. This matrix actually calculates the geodesic distance, meaning the absolute shortest path along the surface, between any two stocks based on the arc cosine of their return correlations. It's a brilliant visualization. If two stocks move perfectly in sync, their distance is basically zero. They sit right side by side on this globe. If they are entirely uncorrelated, they sit much further apart. And if they reliably move in opposite directions, they're sitting at opposite poles. So it gives us this beautiful spatial map of the market's underlying structure.
Okay, so we have the structure. To measure how stocks move across that structure, we use Markov chains. Now, if you aren't familiar, just think of them as ladders. Every single month, all 500 stocks in our universe are ranked into 10 decile buckets, or rungs on the ladder, based on their trailing return and trailing volatility. These chains don't care about a stock's exact price. They simply track the probability of a stock climbing up a rung or falling down a rung over time. By focusing strictly on relative rank rather than noisy percentage returns, the model completely ignores wild, one-off outliers. It literally turns chaotic, everyday financial data into highly predictable states.
To see this predictability in action, take a look at these transition heat maps, which pool data over a whole decade. It perfectly illustrates how order emerges from chaos. Look over on the far left. That bright glowing diagonal line tells us that over a single day, a stock's rank barely changes at all. It's very sticky. But fast forward 21 days, which is a full trading month, and things shift. Look at the return matrix at the top right. It is dispersed into this nearly uniform purple block. Basically, when it comes to raw returns, the market forgets its past after a month. However, and this is absolutely crucial, look at the 1-month volatility matrix right below it. You can still see those glowing corners. That means the calmest stocks and the wildest stocks tend to stay that way. They hold on to a memory that simple, standard math completely fails to predict.
And when we actually quantify this gap, it reveals exactly how much structural memory the market really holds on to over time. You can see this quantified in the red line here, which tracks memory specifically for volatility. Now, during calm years, like say 2017 to 2019, that red line sits very low. The market is just humming along. But look closely at those shaded gray vertical bands.
Those represent massive crises, the 2020 COVID crash and the 2022 bear market. See how the red line spikes dramatically? What this tells us is that during periods of severe market stress, volatility carries a long, persistent memory. The market literally remembers the trauma. This OMD framework is designed to detect that structural memory, a critical edge that traditional linear models completely miss.
Now, you might be wondering, how do we use this to actually make predictions? Well, to gain a true edge, we can't just look at these chains in a vacuum. The secret sauce is conditioning them on market variables. Basically, we inject observable market signals, things like a company's size or its trading volume, directly into the chains. Doing this mathematically adjusts a specific stock's odds of climbing the return or volatility ladder based on the broader state of the market and that stock's unique characteristics at that exact, real-time moment.
To figure out which of those signals actually matter, the researchers borrowed some heavy-hitting concepts from information theory. Let's break down these charts. In the red chart on the left, check out that massive top bar. That clearly shows that past realized volatility is the absolute primary engine driving future risk rankings. It's the big boss. Now over on the blue chart on the right, bars pointing to the right indicate true leading indicators. Again, things like volatility, illiquidity, and size. But look at momentum down there. It's pointing sharply to the left. That means momentum is not a driver. It merely echoes recent past performance rather than predicting the future. It's a brilliant, objective, mathematical filter that strips away the noise and shows us what's really steering the ship.
Thanks to that filtering, the resulting essential predictors are actually refreshingly standard. We're left with size, meaning market cap, market beta, omni-HUD illiquidity, realized volatility, and distance centrality. What's amazing here is what is not on this list. There is absolutely no forward-looking data. There are no complicated, highly delayed accounting fundamentals to wait around for. Everything we need is built entirely on widely available daily prices and trading volumes.
Okay, so we have our matrices and our predictors. How does this translate into a real-world portfolio that we can actually trade? It happens in 4 straightforward steps. First, the system scores every single stock based on its probability of hitting the top return decile and the bottom volatility decile by next month. Second, it builds an optimistic long-only sleeve holding those highest-scoring stocks. Third, it constructs a protective market-neutral long-short sleeve as a hedge. And finally, step 4, it dynamically blends them together. It leans heavily into that long sleeve when times are good and we're in a bull market, and it intelligently pivots defensively to the long-short sleeve when regimes shift and things get rough.
But as any seasoned quant will tell you, having a predictive model isn't quite enough, because trading in the real world costs money. Take a look at the gray line at the bottom of this chart. That represents a portfolio that obsessively trades on every tiny shift in rank. Because of the constant churning, it suffers massive turnover, basically destroying its own profits through trading fees. But look at the commanding red line way above it. That portfolio uses what's called hysteresis rebalancing. In plain English, that's a simple no-trade band. It's like a bouncer at a club. It absolutely refuses to swap out a stock it already holds unless a new challenger beats it by a significant, undeniable margin. This one simple rule slashes turnover and ensures the theoretical edge survives contact with real-world trading costs.
Now for the moment of truth. The graveyard of quantitative finance is overflowing with models that looked absolutely perfect in backtesting, only to fail spectacularly in reality because they were over-optimized to the past. The true undeniable test of any strategy is testing it on clean, unseen, out-of-sample data. To prove this framework actually works, the researcher locked in every single parameter based on data ending in 2021. No more tweaking. Then the model was unleashed blind on completely independent, untouched data spanning from January 2025 all the way through July 2026.
Let's look at the results from that clean 2025 to 2026 window, highlighted in the shaded region on the right. Frankly, the visual is stunning. Watch how the solid red line, which represents our fully diversified OMD portfolio, physically breaks away from the gray market index, just accelerating upward. This isn't a fluke or some artifact of overfitting. The system was simply reading incoming daily data, updating its matrices, intelligently shifting its protective sleeves, and consistently extracting pure alpha from the market structure itself.
And if the chart wasn't enough, the hard numbers absolutely cement this victory. Take a look at this table. During this period, the S&P 500 had a very strong run, posting a sharp ratio of 1.14 and a 20% annualized return. That's a great year for the market. But the OMD portfolio, it achieved a remarkable 1.44 Sharpe ratio, indicating far better risk-adjusted performance and a genuinely staggering 56% annualized return. It nearly tripled the market's raw output, and yes, that is net of a 5 basis point trading cost. All of this operating entirely on observable, public market data.
So we have to ask ourselves, are the rules of efficient markets officially being rewritten? It certainly looks like standard linear models and finicky expected return forecasts might simply be the wrong tools for the modern job. By mapping market geometry through a distance matrix and tracking the hidden flow of risk through Markov chains, this research reveals a deep, structural alpha that others simply cannot see. 3 matrices, no black boxes, and absolutely incredible out-of-sample outperformance. What could applying a framework like this mean for the future of your own portfolio? Something to think about. Thanks for joining me on this explainer, and as always, keep learning.